Welcome. My name is Steve Janz, and today we're going to talk about deferred taxes. And I've created this question to help you out with your BC1 case for CGA Canada. And we're going to take a look at the deferred taxes. I'm going to go through how to complete Schedule 1 and Schedule 2, highlight some of the tricky areas for you to pay close attention to. So you have the question, which is Bobby Jones Corporation, and they are asking you to calculate their taxable income for 2014 and to do the journal entries. So let's get started. So when we read the question and we see a number of things that are involved here for deferred taxes, the first item we're going to work on is point number 6, and we're going to complete Schedule 2. And this is all about the equipment that we purchased in the previous year, 2013. And I want to highlight for you some of the challenges with these calculations and some of the things to pay close attention to when you are doing your Schedule 2 and the journal entries related to that item. Let's get started. So when we are now working on our Schedule 2, we have to calculate the amount of CCA we can take and the amount of depreciation. Well, the depreciation, that one's pretty straightforward. 600,000 divided by 8 years. That means that we're going to take 75,000 depreciation for both years. And it's going to be straight line the same amount. So when we're completing Schedule 2, that's pretty straightforward. We're just going to take 75,000 every year, and that's how we'll complete our second column. Now, when I am teaching deferred taxes to students, one of the things that I encourage them to do is memorize this schedule and always put the tax information first, put the financial accounting, the GAAP information second. And what we can do is we can read it from left to right. And one of the memory techniques that I use is that when we read this from left to right, if we have timing differences that are positive, we know that our ending number will be positive, and therefore we're recording an asset for our journal entry. If our numbers are negative, and I put it in brackets here, we know that we're going to be doing liability type of journal entries. Also, because tax rates change, always work with your ending balances. Never work with the changes that are occurring in the year. Always focus on using your ending balances. And use balance sheet accounting. So make sure your balance sheet value represents what your continuity schedule here shows should be the ending value. Let's carry on, and we'll work on, and I'll review the first year here for you. We started with $600,000 purchase of an asset. So it starts $600,000 for both tax and the GAAP. I've already explained that the depreciation will be $75,000 each year. That's how we get our $75,000 for year 2013 and $75,000 for year 2014. Let's calculate the CCA now. So for tax, they don't use depreciation. They use a declining balance method called CCA. So we're told that our CCA rate is 20%. So 600,000 times 20% is equal to 120,000. Now for tax, for the first year, they've got a special rule called the half-year rule. And for the first year, you're only allowed to take 50% of this value. So that'll be 60,000 of CCA we can take in our first year. So I'll put 60,000 here because we're going to elect to take the full amount. And therefore, that creates my differences here that will be positive. Now, in 2014, we're going to carry on with that calculation. Now, this is a declining balance method. So therefore, we started with 600,000 less the CCA we took in year 2013, our first year. Our declining balance amount is 540,000. We'll then multiply it by our 20%. There is no half-year rule in the second year or any other year. That half-year rule is only for the first year. So then I'll have $540,000 here as my starting amount. I'll take out the CCA I can take in my second year, which is $108,000. I'll then have a balance of $432,000. Now, when I take a look at this calculation and I read it from left to right, I notice that it's a minus $18,000. I'll then, and this is the key part, use the future tax rate that we're told. So we're told that in 2015 that the rate will be 35%, and we know this information before we issue the 2014 financial statements. So we'll use the 35% rate because that is where it's going to reverse itself out at, and we'll set it up, and therefore our ending value there for Schedule 2 will be $6,300. Now, when you take a look at the solution for Part B, and this is a tricky area, and students struggle with this, is what we have to recognize. And if you look at the solution there for the journal entries, and it's the last two journal entries, what we have to do is we have to recognize that we're doing 2014. So in 2014, this is what our balance sheet must show for our capital assets. Now, we know that from the previous year, this is what our balance sheet shows. So we have to do two journal entries. We have to actually reverse this asset out, which you can see as we're reversing it by a credit. And then we have to set this liability up, which you can see as another credit for $6,300. So that is the challenging part of doing those entries here. And you use Schedule 2 to help you out. Now let's move on to Schedule 1. There's a number of different permanent and temporary differences in this question that I want to highlight for you. And I want to go through one in a little bit more detail because you may never have seen it before if you've never taken a tax class. And I want to explain that to you. So Schedule 1, we start with accounting income. We end with our taxable income. It's a reconciliation schedule. And it's basically highlighting the differences between GAAP, which could be private enterprise accounting, or it could be IFRS, versus tax. Not all the rules are the same. One of the things to recognize and remember about tax is tax has a lot of a cash component to it, where we'll recognize cash being spent or received, whereas GAAP uses the accrual method. So we start with our accounting income, and our goal is to come up with what is our taxable income. Now, one of the interesting things about this is that the taxable income will be multiplied by the current tax rate, which is 40%. So our current entry there for tax is 40%. All our other entries, the deferred entries, will be 35%. Now, what we do with this schedule is we break it down into two parts. So we're going to have permanent differences here, and we're going to have temporary differences here. Permanent differences, I explained to my students that the best way for you to understand this is that one side, either the GAAP or the tax, is a yes, and the other side is a no. And it won't change over time. So one says you can use it, one says you don't use it. And that's how I explain a permanent difference. For a temporary difference down here, there will be over time an equaling out. But there is a timing difference now, so that creates a difference in values. But over time, they will equal out. And a thing to remember is that for every one of our timing differences here, you have to do a journal entry. So that's why when you look at the solution for B, there's a lot of journal entries. And I would encourage you, make sure you do a journal entry separately for each of these. Don't combine them. Just keep it separate because it's a lot easier to track that way. Let's get started. What you can see here for meals and entertainment, when you read the question, is that for tax purposes, you're only allowed 50%. So what we have to do is we have to add that back. We had $45,000 in meals and entertainment that we expensed, but tax is saying we can only expense 50%. So we have to add it back and eventually pay taxes on that 50%. The golf membership, that is 100%. We are not allowed to have those annual golf memberships the dues as a taxable amount. So that has to be added back the $4,000. The dividends, I'll move down to the dividends here. Dividends are paid by another company in Canada to our company. And if we were to pay taxes on those, that would result in double taxation. So in this case, we're actually going to subtract out the $38,000 of dividends we received, so we don't pay taxes on that. So that's 3 of our 4 permanent differences. The last one here is about our incorporation expenses of $1,600. And our incorporation expenses of $1,600, they're going to work this way. First off, this is called cumulative eligible capital, CEC, for tax purposes. And how tax works this way is that for 75%, you're going to be allowed to take CEC on. You're going to be allowed to reduce the amount of taxes that you pay over time. For 25%, no, you're not going to be allowed to. So our first calculation here is that we had $1,600 of incorporation costs. We have to add back 25% of that because we will not be allowed to use that to reduce our taxes. That is a permanent difference. And again, that's my explanation of one side's a yes, the other side is a no. And then down here, for our incorporation expenses, now we're moving into the timing differences. And what we're going to see here is that for 75%, that is equal to $1,200. So for $1,200, we're going to add that back because we're not allowed to, for tax purposes, take the full amount this first year. So we have to add that back. But what are we allowed? We're allowed 7% of this for this year. So we're allowed to subtract out $84, which will be $1,200 times 7%. Now our next item, what you can see here is number 5, is the holding loss on a couple of investments. We have to add these losses back because for accounting purposes, GAAP purposes, we were allowed to record this loss. But for tax purposes, we have not sold this investment yet. So again, taxes are based a lot of times on did we actually receive the cash or did we actually pay the cash? Did we actually incur the loss or incur the gain by selling the assets? So in this case, we haven't sold the assets, so therefore we have to add back the loss. We're not allowed to claim that. Our last 2 items here are with regards to our warranty and our capital assets. And the easiest way that I like to explain this is that for the type of expenses these are, for the GAAP expenses, we add them back. So for the warranty, we add it back. For the depreciation, we add it back. And then we subtract out the tax amounts. So the actual warranty paid, we can subtract out. The actual CCA that we can claim as per Schedule 2 and our calculations, we can subtract that out. And remember, if we're subtracting it out, we pay less taxes. If we're adding it back in, we're going to end up paying more taxes. And that's what this Schedule 1 is about. And we come up with an ending value of $296,816. And we'll multiply that by our 40% to get our current income tax expense. All these other ones here will be multiplied by 35% because they are the future amount. So these are the deferred taxes. I hope this helps you with the BC1 case and helps you understand deferred taxes a little bit more. Thank you.